Hello everyone, thank you very much for joining me for today's snapshot. Today we're going to be talking about how the Fed may have a hard time actually keeping rates low until 2023. Now before we do that, just take note of the following important information. Please note that CFDs are high-risk products and that you should be completely aware of the risks that they pose. Also, please note that this is a general market commentary and does not constitute investment advice. And finally, these are our sources of information. Let's just start off with some notes. Now, the Fed remained dovish in its policy statement yesterday. It maintained that rates are not going to rise until there's tangible evidence of recovery. And the Fed chair also said there's no reason to push back against the rising yields. Now, the Fed may find it tough to keep rates low until 2023. A hike earlier may be unavoidable. Let's just bring up some charts and take a look. All right, so the very top chart here is our Fed's fund rate. You can see that it is pretty close to the zero bound. Underneath that is our US 10-year yield. Then we've got the S&P 500. This green line here is total capacity utilization, and this purple line is oil. And you can see that the yields are moving in that northeasterly direction. S&P 500 in that northeasterly direction. Total capacity utilization, the same as with oil. And if we take a look at past relationships, so we'll just go back to the period. This is from, let's see, from about the rates started hiking late 2015, and we're just going to take a look at this period. And you can see that the 10-year is moving up. The stock market is moving up. Take a look at total capacity utilization, it's moving up, and the oil price is moving up. And if you go back over the last two big financial crashes, so the global financial crisis and the tech wreck, and just prior to the tech wreck, you'll see that these correlations seem to hold. Let's just end off with some key takeaways. So if you had to take a look at the dot plots, you'll see that there is already flux in the forecast between December and yesterday's dot plot. And these may become more hawkish sooner than expected. And the market correlations suggest that a hike in the Fed funds rate is a distinct possibility. Thank you very much for joining me today. I hope you found the snapshot useful, and I look forward to speaking with you again in the near future.